Welcome back to the Kelowna Real Estate Podcast. I'm your mortgage broker host, Taylor Atkinson.
And I'm your real estate agent host, Matt Glenn. What's happening today, Taylor?
Yeah, man, just kind of like looking at some upcoming projects and stuff that's being finished. And there's one that you and I were talking about, which is pretty cool out in Peachland.
Yeah, Adeo Developments.
Yeah, you're getting kind of like luxury style living for a fairly good price, starting in the low millions. And they're running an event if the listeners want to go check it out. It's November 23rd, 10 to 3, 5300 Buchanan Road. They're doing a giveaway, $500 gift card to Martin's Lane, which we all love. Yeah, and you can come tour the site. One of the main things I love about this is, honestly, I don't know if it's just me or you as well, but I always look for the deposit structure. So for a limited time, they're still doing just 10%, which is awesome. You don't got to tie up a ton of capital.
And everybody in Kelowna loves their cars. And every unit at Adeo comes with a 2-car private garage, which is quality and kind of unheard of in the city.
Yeah. Funny enough as well, Amanda Hamilton designed it. We had her on the podcast previously. So
yeah.
Oh,
it's all coming full circle for us.
Speaking about other cool people, today's guest, Maurice Matte with Matte and Associates. So they do financial planning, life insurance, critical illness, which we now know Matt definitely needs.
I had a bit of a moment on the show.
Yeah.
But also, Chris puts out quality social media content. It's informative. It's well produced. It looks nice. My God. Before our episode, I was doing some research and I just went through all his videos. I swear I liked like 30 videos in a row. So I wasn't stalking him, Chris, but
yeah, before the show started, we're just like, how do you set up your cameras? Like, why do we look so bad on camera?
Yeah.
And you look so
why
good.
do we look like us and you look like you?
Yeah. So he's pretty dialed in, but yeah, puts out some awesome content, good educational stuff.
Yeah,
definitely worth reaching out to him. And
his big thing is kind of get started planning early. I guess all financial planners do that, but he was really kind of drove the whole point home and made it count for us.
Yeah, I think you guys will like the show. It's a good one. Reach out to him. He's got some good content coming out. Like every show.
We're sponsored by Century 21 Assurance Realty, the best brokerage in the interior of the Okanagan. We're in Kelowna, Vernon, Kamloops, Salmon Arm, Castlegar. Moving out further east in the Kootenays too. We are everywhere you need to be when buying a house in the interior of BC. If you're an agent looking to make a switch, or if you're a buyer or a seller looking for an agent, Century 21 Assurance Realty is the place to be.
All right. Enjoy the show, guys.
Enjoy the show.
Okay. Welcome to the show, Maurice Matte. How are you doing, buddy?
Thank you. Good. Excited to share some stuff today.
Yeah, we've been excited to have you on for a while. So
yeah, we've been trying to get you on, but you've been busy, getting married and going to conferences and all the fun stuff. I actually see you at like every event Emily and I go to. The last one was OC and Elliot.
We were saying every time we go to any concert, I always see Taylor and his wife there.
Yeah, I feel like you guys probably go to like 50 concerts, and the 3 that we go to, we see you there.
Exactly.
Taylor, they probably think the same thing about you.
Yeah. You guys are pretty good musicians as well. Hey, I've seen a few of your videos.
Yeah. We did a little bit of videos on TikTok. It's actually pretty crazy. It went pretty viral. We got 85,000 followers, over 14 million views. I play guitar, she sings. People love that kind of stuff. It's crazy.
Oh my God. Crazy.
It sounds very similar to our podcast, actually.
Yeah. Super viral.
Yeah, similar numbers.
Well, yeah, man of many talents, but let's maybe start with what's your perfect Friday look like? What gives you energy, productivity? Yeah, just walk us through a good day for you.
Sure. Okay. Ideal Friday would be, I like to wake up early. I always wake up around 6:30. A little bit of a biohacking geek, so I like hydrate before you caffeinate, on a bit of an AG1 kick. Love that stuff. Wait 90 minutes before I have coffee. I find that adds energy. Into the office by 7:30, a couple hours of deep work. I'm way more focused in the morning. I can do a whole lot more if I'm, working for those 2-3 hours, and then I take the meetings in the afternoon. After that, I just come home, we make dinner, I do a workout and relax, prep for the weekend.
Nice. I love it. Yeah, the 90 minutes before caffeine is a huge one for me as well, actually. Well, tell us about, what is your work? What do you do? What do you kind of specialize in?
Yeah, so I'm a financial advisor. We have a private investment management firm in Kelowna, and we specialize in holistic financial planning. We manage about $250 million in assets under administration for about 2,500 clients. We also have about the same amount in death benefit. So Not a small firm. We know what we're doing. I only share those numbers to show some authority that we can actually speak on the matters that we're talking about. So there's a lot of advisors out there who don't have the experience and they're just talking about these things they've never actually implemented. Our firm was started about 30 years ago by my father. He grew it into one of the largest firms for our brokerage in the country. And I always tell people I'm one of the only 27-year-olds in the country who has about 10 years experience in the financial industry. I was doing paperwork since I was about 16, licensed really young at 19, and I was able to hit the ground running. And it gave me a really good back end for understanding the business, how it works before I was actually licensed and operating.
I love it, man. Maybe let's start with, a bit of real estate stuff. Where do you see opportunities? Like there's been a lot of changes, let's say first home savings account. You guys obviously work with clients, coaching them on that stuff as well. Do you want to talk about anything like that?
Yeah, absolutely. FHSA is a beautiful account that was brought in by the Liberals. We won't get too political, but I think it's one of the only things they've done really well.
Yeah.
It's a pretty amazing account. So on the way in, it's like an RSP. You get $8,000 a year. You get tax deduction on that. So come tax season, if you put that in, you're going to get a tax refund. On the way out, any growth that you have is going to be tax-free. So it's very similar to a TFSA. You take TFSA, RSP, combine them in one, you have your FHSA. Interesting ways you can use them. We actually had a client who had already purchased a house. And people don't really know this, but there's no minimum amount of time that you have to have the money in an FHSA. So it's even useful if you've already purchased a house and haven't closed. So what we did was we deposited $8,000 into this account, and literally the next business day we withdrew it. So what that's going to do, the money's not invested, so he's not getting any growth. But what it's going to do is he's going to get that tax deduction for the 2024 tax year. He's going to get like $3,000 back on his tax return just for making that move. And he had already bought the house, hadn't closed yet.
Yeah. It's actually amazing how many people aren't aware of this program. Like I feel like the government should be out there, parading this because this is such a powerful tool.
Totally. Well, and one of the things too, like people don't know that it's not like a TFSA. A TFSA, the second you turn 18, you start to acquire room every year. But with the FHSA, you actually need to have an account open to start acquiring that room. So I tell people, even if you don't have the money to deposit into that account and you're planning on purchasing a house in the future, open that account before the end of the year. Otherwise, you're going to lose that $8,000 contribution room you otherwise would have had.
Yeah. Yeah. Super powerful. You were also obviously working to coach people to build up savings for their down payment and stuff like that. Do you have any good strategies for us to help people get into the market? Like obviously that's a big hurdle that we face as well. Is just how do people come up with a down payment?
Yeah, totally. There's a couple of different ways that I kind of coach people and help them to come up with those down payments. One is obviously, and you're going to hear every financial advisor talk about this, is automating the payments. So super important that once a month or once every 2 weeks, you automatically have money pulled out of your bank account. You treat this like any other bill, and that gets deposited into, let's say, the FHSA, or even potentially we have some first-time homebuyer RSP options. If it's automated, you're going to do it. If it's not automated, that money is likely going to get spent. So that's one way that we help clients with a little bit of discipline and saving. Another great way is if their employer offers an RSP matching program, we say, absolutely take as much advantage of that as you possibly can, because every dollar that you put in the RSP, your employer is going to match it up to a certain percentage. And the government changed the rules so we can use up to $60,000 from an RSP to purchase your first home. So while we do have to pay that back, it's still a great strategy to save, get that tax deduction when we need it, when we're coming up for that down payment.
Yeah, it's funny. I was criticizing that increase when it came out previously and saying like, how many people have this much as a first-time home buyer in RSP? And then like 2 weeks later, I had a client that had exactly the maximum amount. And I was like, all right, well, I'll put my foot in my mouth there. So,
well,
yeah.
And that's just the thing, like $60,000, and you have to pay that back. So I have to relook up the rules. I think it's now, they changed it to 4 years after you take that from the RSP. You have to pay it back. You essentially take the amount, split it up into 15 years, and that's how much you have to pay back. So $60,000 over 15 years is a huge amount for people who are, bought a house, they have these heavy mortgage payments, and, that's where their discretionary income is going, and it's going to pay back the RSP. probably not the most efficient use. And unfortunately, what happens with the RSP is most of the time people just take it as income. So if you don't pay it back, you take it as income for that year. It's at your highest tax bracket. So you're actually paying more taxes on that than you would have otherwise. So, we used to use RSPs a little bit more, but now that we have those FHSAs, if you and your spouse are able to do that and you have a 5-year time horizon, that's 40,000 total each you can put in there plus the growth on it. So we have some serious room that we can put into the FHSA that we don't have to pay back. And then we won't have to end up with that tax burden if we don't pay it back.
Yeah, that's such a good point. It's such a powerful tool, but like we really won't see the effects of it for a couple more years. Kind of like the TFSA, it started out like, wow, this is great, but it takes a while to build up.
Totally. Well, and that's the thing with the TFSA. Like it was opened in 2009, and I have to look back with the first amount. I think it was $5,000 a year.
$5,000, yeah.
Yeah. So for somebody who, in 2009, 5,000, 10,000, then the conservatives did another 10,000. So we're adding up. But many years down the road, we have a huge chunk, like we're over $95,000 worth of room if you were over the age of 18 in 2009. So you invest in a TFSA like that, you can invest completely tax-free, build a huge retirement savings, and have all that tax-free income in retirement. So now it's becoming more and more important to take advantage of that account.
Yeah. Speaking about closing on a property, this is something that comes up in my conversations every time. As a mortgage broker, we have to like present, a type of life insurance, like a covered mortgage. Obviously, this is, your area of expertise. So I generally like make the introduction off to a financial advisor because I'm limited to sell just a couple products. And then we were talking previous to this show, like critical illness as well. Do you want to talk about the types of products that you have access to and, why people need them?
So a lot of people, when they get a mortgage, they're offered by their mortgage broker or their lender a life insurance product that's tied to that mortgage. So they don't own it. It's not there to protect them. It's there to protect the bank. Unfortunately, these products are quite expensive because they don't do any medical underwriting. They essentially pair everybody into one group, and that's how they price out the insurance. Where with a life insurance policy that you own, it's going to be a lot cheaper if you're healthier. You can own that for a period that's a lot longer than your mortgage period. And you're not essentially subsidizing the insurance for these unhealthy people. So it's a lot better way if you can get your own life insurance policy that covers more than just your mortgage, and it doesn't decrease over time. So a mortgage insurance, or the insurance tied to your lender, it's going to decrease in value with the mortgage over time, and it's going to be more expensive. But a policy that you buy on your own is going to remain level for the period that you own it, let's say 10, 20, or 30 years. And the price is not going to go down or up. It's going to remain level. And the death benefit's also going to remain level. So if you have a $500,000 mortgage, you're going to get $500,000 of insurance. It's going to pay out $500,000 in the future. And it doesn't matter what your mortgage value is. So I always tell people when they're getting a mortgage, don't take the policy with the lender, or if you do take that, go and look at a separate life insurance policy that you're going to own, and then you can cancel the policy with your lender if you're approved for the cheaper prices.
Yeah.
So what kind of insurance people are getting, like 20-year terms? Like what about whole life insurance? You deal with that?
Yeah, so I want to be really careful with how we have this conversation. There's a lot of people and a lot of advisors out there who are going to push whole life insurance. And I'll be completely honest, it's because whole life insurance pays advisors about 8 times what a term life insurance policy would. Now, for 90% of people who are using most of their budget to purchase, their home, and all the cash flows going to the mortgage, they need as much life insurance as they can get to cover their mortgage for as little cost as possible. So what we're typically doing is insuring these people with term life insurance. So like, I'll give you an example. $1 million policy on like a 35-year-old male is only going to cost like $42-$43 a month. That's going to cover $1 million if they pass away in the next 20 years, cover the need for the time being. Whereas a whole life policy, They're fantastic and exceptional for the right use case. And we can get deep into the weeds on whole life, and I don't think we need to here. But there's a whole bunch of tax advantage ways you can use them through corporations. Also planning for children's education, a more flexible way to save. There's a number of different ways. But typically when we're covering mortgages for the lower income families, we like to see term insurance.
So what about, like, you said 35-year-old male, like, is there like a steep decline after that? Like, when's the most optimal time in a person's life?
Like Matt and I are still active, we're playing sports, we're healthy, so.
Well, I just mean, like, Taylor and I both have young kids, so I imagine right now would probably be a good time to get term life insurance to like kind of cover them growing up. But like, I know that I've heard of quite a few people that are like retiring, and then they realize that they don't have any insurance, and they go to get more insurance, and obviously way more expensive if you're 60.
Yeah, that's exactly right.
Is there a time where you should kind of advise people on that?
Well, it all matters on the goals. And like I say, life insurance companies are private companies. They are for profit.
Yeah.
And the way that they price life insurance is based on risk. The three of us, we're young. We're likely not going to pass away in the next 10, 20 years. Hence the price. We give 40, 50 bucks a month to the insurance company, and they guarantee they're going to give us $1 million.
Yeah.
So most people don't use their term life insurance products, and that's why it's so cheap. It's just like car insurance. Pay the premium. If you don't crash, you don't use it. If you are older, somebody in their 60s, your chance of passing away goes up.
50-50.
The stats of people who pass away goes up, and that's why the insurance is more expensive. So if we're needing insurance later in life, and we know that need is going to still be there, that's somebody who's a good client for a permanent product, who we can do some more planning on the cash value side. A permanent product has an investment side, and plan to make that insurance a lot cheaper. There's actually a crossover period. Permanent insurance is quite expensive, and then term insurance crosses over and it becomes more expensive the older we get. So if you can get that permanent product in place, you can actually have it paid up and not need to pay any insurance in the future. So it really depends, guys. We have to sit down with the client and see how long are they going to have that insurance need.
Yeah.
There are certain term products that you can convert over to whole life when that expiration comes up. Like if you do a 20-year term, do the insurance companies reach out, or do you guys facilitate that and say, like, do you get a discount on the whole life if you transition over, or how does that look?
Yeah, so it's not a discount. It's actually almost all term insurance products have the ability to convert. Now, if we are going to potentially be converting that in the future, we want to make sure we're in a company that has good permanent products. So I'll use myself as an example. I got 2.5 million of term 20 insurance. That has the ability to convert to any permanent product that I want in that 20 years. The cool thing about that is I can convert it without any medical underwriting. So if anything happens to me, if I get cancer, heart attack, stroke, anything like that would make me uninsurable, I can still get that permanent product, lock it in, and make sure that I'm still insured in the future. If I come to the end of the period, we can reapply for a new product before my current product has expired. If I don't get approved, then we can look at converting. But again, it all matters what the goals are with the insurance. There's a ton of different ways we can set them up.
If you did that conversion, there would probably just be no cash value to transfer over, right? Yeah. Okay.
No, exactly. Because like I say, the term insurance is super cheap. You're not building cash value. It's just there to protect your family for the time being.
Yeah. Before we just continue to bore listeners, one more insurance question.
Sure.
I've always been fairly passionate about this, but I'm curious to hear your point on it. First off, congratulations. I know you guys are expecting a new edition pretty soon.
Thank you. Yes.
So with that, welcome to the chaos of Matt and I's life with kids. But with that said, is this one of the first points of review with clients when they're talking about having kids or have young kids? Like, hey, maybe we should set up a whole life policy early because we can build that cash value and it's cheaper and the medical underwriting isn't there? Or do you just say, we're not going to worry about building wealth? And I know it depends on cash flow and, clients planning, but is this an asset or a tool worth exploring right off the bat?
Yeah. So if we run the numbers, and this is going to be for the upper middle class, I'll be honest, it is a little bit expensive, but if the client can sustain the level of premiums for the duration of the policy, which is normally paid over 20 years, it's an exceptional way to save and a flexible way to save for your children for either education. And if they don't use the cash value for education, It then continues to grow and they can pull it out for a down payment on their first house. If they don't need that, it continues to grow and they can use it in their retirement. So yes, it is a super exceptional way to save for your kids' future and build wealth. And the earlier you can start that, the cheaper the insurance is going to be, because the likelihood of a child passing away is next to zero. The insurance companies price their insurance based on that. So most of the premium that you're paying is going to building that investment portion. So it's more of an investment product than an insurance product. But the beautiful thing about it is that it grows tax-free.
Yeah.
Awesome. Sorry, I have to ask, there's one more insurance question.
Sure.
So like, hey, talking about critical illness or like me getting sick. So last night I was going through your Instagram, liked all your photos. You probably saw 2 million likes this morning. I was thinking last night, like we have a lot of life insurance, Beck and I, like we're totally covered that way. But like, if I don't die, like we're in a situation here, right? So like, what do people have to do that? Like almost like if I have a stroke or something, like it's like, Becca, like just push me over the edge here. Like,
push me down the stairs, finish me off.
Like,
well, here's the thing: disability or critical illness can actually be a lot more of a financial impact on your family than a death. And it's crazy to say that, but think about it. You still have your mortgage, you have increased financial strain because you have new medical expenses, and you're there more, as a burden to the family. So the other individual in the house can't take care of you. And it's unbelievable how many people actually, get these things. So 3 main ones: cancer, heart attack, stroke. We're all young guys. We'd never think that we have any risk of that. So why would you get critical illness insurance? Well, 2020, thyroid cancer. I got my thyroid taken out.
You have got to be kidding me.
Last thing that I was thinking about was, do I need to continue working? Am I able to continue to work, or should I focus on healing, recovery? Unfortunately, I didn't have critical illness. I was young and I didn't think I needed it. I should have had it, and it would have paid out. I probably would have had a $200,000 policy. It would have paid out. I could take a couple years off and rest and recover, make sure that I'm healthy, and then go back to work. So insurance hierarchy: life insurance, disability, critical illness. But in reality, it should be critical illness, life insurance, and disability kind of on the same level there. It's so important to have that coverage.
Okay.
Yeah, that's a wildly impactful story.
Yeah. I mean, it sure makes it easy for the conversation when I'm talking to clients.
Yeah.
I was stressing for the right reasons last night. Sweet Jesus.
Yeah.
Matt just had the sniffles, thought he was going to be out of work for a week.
I didn't even have that. I was perfectly healthy, thinking, Jesus. Actually, I had a shoulder injury that's bothering me, and like just the most minor possible thing, but it gets you thinking, So
absolutely.
Yeah. Well, that's very cool. So I think we should all look into that, especially me. You don't need it till you need it, I guess.
Yeah, absolutely.
That's a pretty good segue into other like do's and don'ts. So for just financial planning in general, like what do you see in kind of the biggest mistakes people are making? Because that's obviously one of them.
Yeah. So people are taking on debt to buy depreciating assets, and I can't scream this from the mountains loud enough. We have 2 types of debt. We have good debt and bad debt. People are taking on good debt. This is what the wealthy do. Good debt is when you take on debt to buy an appreciating asset. So let's say you're buying real estate. Take on a mortgage, buy an appreciating asset. Even better debt is when you're taking on a mortgage to buy an appreciating asset that's a rental that you can then write your interest on the mortgage on. So that's building your net worth. On the flip side, we have things that destroy your net worth, which is bad debt. So this is, and I hate to say it, everybody has it: vehicle loans. You buy a brand new vehicle, you're paying interest on the financing. The second you drive it off the lot, it's depreciated 30%. You can't sell it for what you bought it for, and it continues to depreciate. So what does that do? That destroys our net worth over time. So I keep trying to tell this to clients and people. Try to stay away from those types of things. I understand some people need to use lines of credit when times are tough, credit cards, things like that. But if you can stay away from those depreciating assets that are, purchased on debt, do that as much as you possibly can.
Yeah. I mean, from the mortgage side too, like car payments just kill mortgage applications. So yeah.
Yeah. And it's a lot easier to get approved for the car payment after you get the mortgage. You might not get approved for the mortgage payment though if you have the car payment first.
Yeah.
Totally, yeah. And don't buy a car like a week before closing either.
Exactly.
I know you laugh. That is
We always talk about that, but do people do that a lot?
Yeah, I've had that and a boat, and both times almost killed the deal.
Worst. Most of the time, boats, you get into negative equity in the first few years.
Yeah.
Yeah, and they cost like $300 a day in gas.
Yeah, it's unbelievable. So do's and don'ts from a financial advisor, don't buy a boat. We've run the numbers, you're better off to rent a boat for the amount of time
Absolutely, man.
you end up so much more ahead.
Yeah. We were part of the boat club a couple times. Like, it is the best service you can get, and like the cost is nothing in comparison to
Yeah,
owning
and
a
it's
boat.
also nice. You don't have to, do your oil changes, maintenance, all that kind of stuff. They clean it, they put the gas in it. You just take it out and bring it back.
Yeah. Or
Yeah.
better yet, just have a friend that has a boat.
Yeah, that's
Exactly.
usually my strategy. Yeah.
Yeah. Yeah. Matt and I are in a standoff. Who's getting the boat? Okay. What about like average cost of retirement right now? And I know it's probably been super volatile for you, but like, I'm assuming you're planning with clients basically every week, sitting down saying, here's where you are in your age. Here's kind of your life expectancy. Here's your average spending limits. What do you generally see? Like, are there any rules of thumb people should be planning for? Like,
Well,
yeah, how do we quantify
the better
retiring?
question is, how are you used to living? What's your current standard of living? And if you want to continue that standard of living, how do we get you there? So what we do is we sit down, we put all of their information into a financial plan. Because one of the biggest questions I get is, I have a lump sum of money, I'm 45, 50. How much is this going to give me in retirement? And is my retirement going to look similar to how I'm currently living with my cash flow? Or am I ahead or behind on my goal? So what we do is we sit down and put it all into the plan. If we're ahead of the goal, fantastic. If we're behind the goal, we can then show you the different strategies that we can use to get you to that point. Retirement income varies person by person based on how they're used to living. So we can't put a number on that. In terms of how much investments you should have, a general rule of thumb is if you can sustain your retirement income with a 4% withdrawal rate from your investment account, your investments will never run out if they're managed appropriately at low risks, retirement income style investing. So we sit down, we come up with that number, we show the client, and then we track that over time and make sure that they hit that. And then for retirement, like there's different stages of retirement too. We find once people retire, they go gung-ho, they travel, they have high expenses, they're going out for dinners, all this kind of stuff. And then so we're at a high stage, and then we slowly go down as we get away from the traveling. It becomes a little bit more difficult. We're still living on our own, so we don't have those high expenses. And then over time, it slowly ramps up near the later parts of retirement as we need assisted living. That's incredibly expensive if you aren't on a subsidized program and things like that. So it's a little bit of a moving target. So we have to make sure that clients have enough money to be able to sustain that.
Yeah, it's got to be a stressful job, hey, to be the one to be like, yes, you can retire. Like, you'll be okay for the next 20, 30 years. Like, yeah, that's a lot of pressure, man.
The even harder thing, and what I hate doing, is unfortunately some people come too late. They come to me when they're 45, 50, 55, and they want to retire at 60, 65. And I have to sit across the table from them and tell them that they can't retire when they want to retire. They either have to reduce their standard of living or work later. And that's a tough conversation to have. I don't enjoy having that conversation.
Yeah.
Okay, I have a point here. So the reason why I bring this up is because I run into this like way more than I thought I would when I started this business. A lot of people, I've helped them that are retired. They own a house that's like around $1 million, like either low mortgage or no mortgage on this house. But the people have virtually no cash flow. Like they're living on pension. What should I be telling people like this to do? Because I feel like it's almost like a swear word to some people to even mention that they have like a ridiculous amount of equity in their home.
Yeah.
But like they also would never, like they've owned a home for 50 years. So they're not going to rent, or they're at least not immediately open to that. But their standard of living is going down, but they are sitting on $1 million. I've struggled with what to do on this. Like for just a quick story here, like I had people exactly like this. They wanted to buy another house. We sold their house, unconditional offer, and we went to go buy another house. So the house hasn't closed yet. We were still waiting for the proceeds, but we went to go buy another house, and I was like, "Hey, we need to put a deposit on this house. So, like, do you have $10,000 to put it on?" And they're like, "No." I'm like, 5,000? No. I'm like, 1,000? No. Do you have $500? No. You don't have any money, but you're sitting on $1 million. What do I say to people like that? Right?
So most people have majority of their net worth in their primary residence. And
Yeah.
one of the things, I don't know if you guys would agree with this or not, but I'd say your primary residence isn't a super great investment when you look at it. But what I tell clients is it might save your retirement. So
Yeah.
we see this all the time. People have, $1 million house fully paid off and no income. So,
Yeah.
the beautiful thing about the house is they've been forced to pay it down over the years.
Yeah.
If they were renting at a lower amount, that money would likely have gotten spent.
I love that. This is what I tell people too, is owning your principal residence, they say it's not a good investment, but it is like a forced savings account. I totally agree with that.
Absolutely.
Yeah.
And the amount of people who I've seen that strategy has saved their retirement is unbelievable. If I'm being quite honest, it's most of the people that come to us, they have a huge house, a little bit of investments, enough to sustain them for a while, but they need some strategies down the road to tap into that. There's a number of different strategies. We could get deep into the weeds. We don't need to, but you can reverse mortgage. I'm sure Taylor can talk about this for a long time. You can sell and downsize. You can sell and invest that money, live off the income and rent, and actually end up way more ahead, depending on what type of investments you're in. So bunch of different strategies. For some of these people, it is very difficult. They don't want to sell their homes, but some of them do need to. And we do have to have those hard conversations with clients. If you want to live the way you want to live, you want to continue with your lifestyle, this is what we need to do. And sometimes that means selling your house and downsizing, or pulling some of that equity out with leverage strategy ways that Taylor could speak more to.
Like, people don't even have to downsize most of the time, in my experience. Like, they just live in areas where the property values are so high. Like, the house isn't especially big, just expensive because it's like downtown or something, right? So yeah, it's funny to have this conversation. Like, maybe I just need to throw them your way or throw them Taylor's way. Like,
I am biting my tongue here. Yeah, throw them my way, you freaking idiot.
Because that's a hard conversation to have. The three of us in different ways.
I see this like so much, right? Like, it's
so here's why
everybody.
It's a tough conversation. Like, I've had similar clients as well.
Yeah.
Because their mindset over the past 20 years was pay off debt, right? Like, debt was quite expensive in the late 80s, early 90s kind of thing. So I understand where they're coming from. And the whole goal to retire was previously like wipe out debt, live off a CPP, OAS, a bit of savings. It just doesn't work right now. So yeah, with those clients, they don't have income to access the equity is one big issue. So yeah, you can go on the reverse mortgage side, which obviously you're giving up equity to, the lender over time.
Yeah.
Nothing wrong with that product. Alternatively, there are like equity programs where you can qualify to tap into equity just based on the loan to value of your house. And there's high net worth requirements. So you can also use like any other liquidity that you have to qualify. So there's a lot of ways to qualify for liquidity in your house that generally banks don't like advise on, right? It's always, what's your income? What can we approve you for? So we have that conversation. And then we just lay it out and say, okay, this is going to cost you, $2,000 a month in interest. Are you okay with that? Because we're going to take now the liquidity and put it in an investment that's going to service that debt. If it's structured correctly, there's also tax benefits to that. You can write off the interest on your primary residence if set up right. Here's the main question I usually say right off the bat is like, do you have any estate planning? Like, do you care if, your kids or anyone has equity in your home? Because at this stage, it's costing you the lifestyle that you want. So like, does it really matter if you pass on an extra couple $100,000 to your kids or not? Or can we, chew up some of that equity, leverage it, reposition it elsewhere, and allow you to live in the house you want to live in for the next 10 or 15 years, but maybe you don't pass down as much in the estate when you do kind of pass on? Because yeah, the downsizing is a real thing, but like property transfer tax, legal fees, commission, you're giving up a lot of cash just in that transaction to live in a smaller place, to tap into that equity anyways, to basically hold on to net worth to pass on to your kids. So I think that's the big question is like, how much do you want to pass on to your kids or not? And then to circle back is, well, if they had any kind of life insurance pre-planning, they wouldn't have to worry about that so much. There would be a benefit to that.
Yeah, absolutely.
I got a question, which may be very difficult to answer, but maybe you're thinking about it now, is how much do kids cost? And like,
well, I'm about to find out, right?
Yeah.
So Taylor, you could probably tell us a little better on this. Taylor's got a little guy. We do financial plans and we build some of that into the plan. But I did look up the numbers here. Let me take a peek. And again, this varies by demographic.
Like my personal experience so far, it has not been that much money, but like I want him to play hockey.
So I've got a really good friend. They were looking at a private school for their kids. He's got 3 kids. The duration of that private school from, grade 1 to 12, not post-secondary, was going to be $900,000 per kid.
Yeah.
What school's that? 900,000 per kid?
Aberdeen.
Yeah.
Okay, Aberdeen's like 12,000 a year for grade 1 and like 20,000 a year for grade 9. How would that work? 900 grand?
I got the number here.
Okay,
So,
let's see.
and I think this is way underwritten, and it also depends on demographic, but Stats Canada says about 293,000 from birth to age 17 for a 2-parent middle income family with 2 children. So average of 17,235 per year. We need a bigger home. So a lot more mortgage payments. We need the bedrooms. We need a bigger vehicle.
Bigger depreciating vehicle?
Yeah, absolutely. A vehicle that you own. If you're sending your kids to a private school, that adds up. There's so many things. Sports, like you say, hockey. I have clients who are spending over 30,000, 40,000 a year.
Yeah, I heard that.
They're like 9-year-olds in hockey.
I know. I heard that.
So completely depends. I think you can do it fairly cheap, but
Well, yeah. I mean, like
the experience.
daycare right now, sure, there's some $10 a day daycare if you can get in the 2,000 person wait
into
list.
those 9 spots that are in BC.
But otherwise, yeah, it's like $1,200 a month.
Yeah.
So you have a couple kids. Yeah. The trade-off is like, oh, okay, well, maybe like somebody doesn't work so much, so they're staying home with the kids. Now you're losing that income. So I think there's like also a loss of income to it. Hey, love my kids. They're worth every penny, but just curious of a stat. Like those are just obviously
The
changing
interesting
numbers.
stat, though, is like for a 2-parent household when both parents are working, typically, like it depends how much one of the spouses are making, but it's normally a wash if you send the kids to daycare or if you stay home. So if that's the case, do you want somebody else raising your kid or you raising the kid and doing all that work for free? So I don't know. It's a tough thing. It's, I guess, up to each parent to decide.
I guess, like to circle this conversation right back, if one parent's not going to work and stay home, and then the other person needs to get some damn insurance, like some critical illness insurance. Like this is the situation.
So that's the biggest thing.
I'm
going to be doing a whole bunch of videos on this because it's a big thing in my life right now. Everything with financial planning is triggered by life events. Marriage, children, home purchase, which have all been things that have happened in my life in the last couple of years here. So I understand how all this works. I'm a financial advisor, but I'm trying to spread the knowledge out there for people who don't understand, and so they can make the right moves and make sure their family's protected.
You have to start thinking about this because you're right. There's so many things and you don't know what's going to happen. So you just got to be prepared.
Well, here's a question to ask yourself. If you were to die in the next 30 seconds, you're in the last 30 seconds of your life, how big of a check would you have to write your family to make sure that they didn't have to worry in the future if you weren't there to help them live? And if you don't have that saved up in an account and you can't write that check today, you need life insurance. There's no questions about that.
Well, like I was saying before, if I die, we're okay. But if I'm like halfway there, we are up the creek, bro. So
Hey, we're gonna talk after the show then.
I'm moving in with Taylor. We're coming over, Taylor. We're never leaving. Yeah.
Perfect. All right. Well, maybe we'll leave it there and dive into some of our wrap-up questions.
Sounds good.
You got me scared. I've got 30 seconds left in my life here. Okay. If you could buy one property in the Okanagan in the next 12 months, what would it be?
Tough one. My family's always been a real estate family. We have a bunch of different investment properties. I'm actually in the next 4 days here closing on, we got a townhouse for an investment property. So
nice.
I'm going to go on the other side, go to the recreational side. I would love a place at Big White. I think that's just such an exceptional area, even long-term opportunity for growth. I don't know if you guys have seen Big White's plan for the next 40 years. They're going to expand them out, and I think it's a pretty cool spot if you can purchase something up there.
I agree. We actually had an episode about that on here.
Oh, really?
Yeah, we did. There's a lot going on up there, so that's pretty cool.
Yeah.
If you could give your 20-year-old self any piece of advice, what would it be?
Instead of buying the $1.3 million house at 25, buy the $700,000 house at 20.
Yes,
right.
That would be
get into it earlier.
25.
Yeah, absolutely. Of course, if you have the savings to afford it. The other thing I would say is automate. Make sure that you're paying yourself first into your investment accounts. treat it as a bill. If it's not treated as a bill, you're going to spend it on other things. So make sure that you're automating your investments.
Yeah. And I'll tack on that. Even if people are intimidated to doing that, like do it for 6 months and then reassess, because I guarantee they'll forget about it after 6 months.
Totally.
Okay. What's your favorite charity, or how do you give back?
Yeah, so I'm on the board of directors for a charity in Kelowna called Freedom's Door. So they're a drug and alcohol rehabilitation home for men. Amazing program. These guys come in and they're hurt. They've been through the most unbelievable stories of growing up without parents, on the streets, addicted to drugs and alcohol. And within the 90-day program that they're there, they completely transform. It's unbelievable. We help them transition into society. So there's 2 different parts to it. 90 days, where it's like the first 90 days of being clean. It does run through the 12-step program. Then they go through the continuing program. And one thing that we're trying to do now, we're actually adding another 54 beds. So currently we have 98 beds. We're doing townhome projects to add another 54 beds, because the biggest issue that Freedom's Door is having is the bottleneck of people on the wait list. There's a list of 50 people at any time who are trying desperately to get into the program to get clean, and we don't have it. So we've raised about 1.6 million for these townhomes. We need about another 1.6 million for the next phase of the townhome. So if anybody wants to give for something that's an exceptional place and a local place that's helping a lot of people.
That is awesome. Where are the townhomes being built? Can you say, like, is it?
Yeah, it's on Bel Air Avenue down in Kelowna.
Okay.
Nice.
Yeah.
Awesome. And so you guys are fundraising money. Like, do you do any events, or obviously there's probably a website?
Yeah, so if anybody wants to go and donate, you can just go to the Freedom's Door website, and they have a bunch of different ways. Super easy. We also run a car wash every year. My family used to own the Mission Super Wash, so we started that annual car wash that supports Freedom's Door. We've been making about $40,000-$50,000 a year every year with that program. Then there's also a banquet every year that makes the same thing, around $40,000-$50,000.
Cool. That is amazing, man. I love it.
That is very good. That is just awesome. All right, Chris, how can Taylor or I or a listener help you?
It's more like, how can I help you?
Yeah, I like it.
If people want to go and follow my Instagram, I have a bit of a passion project there. As you can see, I love making videos.
You put out quality content.
Yeah, thank you.
I can vouch for that. Yeah.
There's a lot of people, financial knowledge is not widely dispersed. It's not taught in school. So kind of set on a bit of a mission to help people. So I do videos about 3 times a week. I post them, financial tips. If people want to go and comment or DM the word grow, I'll add them to my email list. I send out 2 times a month, which is just educational emails with tips, just like we were talking about the FHSA or insurance.
Yeah.
So it's always top of mind. If you comment guide, I'll send you the link to my free guide. It goes over how to get out of debt, how to build an emergency fund, how to grow your retirement savings. So great resource for people who are just starting out. And if people do want to work with me, I'm absolutely happy to do that. I normally start out with a 10-minute conversation. Just see if we're a good fit, see if we can help. If we can, and we agree that we're a good fit, then we can discuss next steps and moving forward. So if people want to do that, they can just reach out to my email. They can search us up online, Matte and Associates Financial Solutions, and just go book a meeting.
Wicked. Yeah, we'll put all that info in the show notes as well. Yeah, I appreciate your time, man. Yeah, your social media has been awesome. So yeah, we love it.
Thanks so much.
Yeah, great time talking to you too.